Every empire swears its money is untouchable. In the early 1980s, the United States had the most powerful currency on earth. The dollar was so strong that American tourists joked about Europe being on sale. Japanese exports conquered global markets. Wall Street was roaring. Politicians pointed to the exchange rate as proof of American dominance and economic genius. And then in September 1985, a small group of finance ministers and central bankers walked into a luxury hotel in New York and quietly decided that the dollar was too strong, too dangerous, and that they were going to break it. No war, no election, no national debate. Just a meeting at the Plaza Hotel. Within 2 years, the dollar had lost almost half its value against the Japanese yen. Fortunes shifted, trade balances changed, bubbles were born, and millions of people who never heard the words Plaza Accord in their lives felt the consequences through their jobs, their savings, and the price of everything around them. So the deeper question is simple and unsettling. If money is supposed to be the ultimate free market, how did a handful of officials bend the world's reserve currency on purpose? And what did it cost the people who trusted that the value of their money was something solid, something real, something beyond politics? The story of the Plaza Accord is where money, power, and history collide, and where you discover that nothing in the financial world is as neutral as it looks. On the surface, it was a technical agreement about exchange rate misalignments. Behind that language, it was a deliberate attempt to shift who wins and who loses in the global economy by changing the price of the most important thing of all. The unit everything else is measured in. To see how we arrived at the day the dollar bent, you have to go back a few years, to a time when the dollar looked less like a wrecking ball and more like a patient in the emergency room. In the late 1970s, the United States was drowning in inflation. Oil shocks, political turmoil, and years of loose money had eaten away at the value of the dollar. Prices were climbing so fast that people stopped trusting their paychecks. Saving felt pointless. Paying off a debt in the future with cheaper dollars seemed like the only rational strategy. The world's reserve currency was drifting toward a slow-motion credibility crisis. Then came Paul Volcker at the Federal Reserve. Volcker decided that inflation was a bigger threat than unemployment, bigger even than recession. He pushed interest rates into the double digits. Some mortgages crossed above 15%. Borrowing became brutally expensive. Construction slowed, businesses failed. Unemployment rose. Farmers protested. Politicians raged. It was economic chemotherapy. It almost killed the patient. But it did kill the disease. Inflation broke. And when inflation finally cracked, something else happened. A world hungry for stability and high returns suddenly saw the United States as a magnet. If you were a foreign investor in the early 1980s, the logic was straightforward. Lend to the U.S. government in dollars and collect some of the highest risk-free interest rates on the planet. Capital flowed in. Money poured across borders into dollar assets. As that torrent of money arrived, the dollar soared. By the mid-1980s, the dollar wasn't just strong, it was crushing. It rose by roughly 50% against a basket of major currencies in just a few years. For American tourists, it was a golden age. For anyone trying to sell American goods abroad, it was a nightmare. Imagine building cars, machines, or industrial equipment in the US, only to watch your product become 30, 40, 50% more expensive overseas, purely because of the exchange rate. Many companies didn't suddenly become worse at making things. They simply became more expensive because the unit they were priced in had launched into the stratosphere. On the other side of the ocean, the story looked very different. Japan and West Germany were running huge trade surpluses with the United States. Their currencies, especially the Japanese yen and the German mark, had not risen as much as pure economics might suggest, partly because their own policies tried to tame the impact. Their goods were cheap in dollar terms. Their factories were booming. Their export sectors were thriving. And that created pressure, economic pressure, political pressure, social pressure. In the U.S., manufacturers and unions complained that the dollar was strangling American industry. Cities built on manufacturing began to hollow out. In Congress, talk of tariffs and protectionist laws grew louder. Commentators warned about Japan Inc. hollowing out America, about unfair trade, about lost jobs and shuttered plants. The strong dollar, once a symbol of pride, started to look like a loaded gun pointed at America's own export base. In Japan and Germany, politicians worried that their dependence on exports to the U.S. made them vulnerable, but they also knew something else. If Washington's frustration turned into tariffs or trade wars, everyone would suffer. Something had to give. Governments could not change the past. They could not undo Volcker's decisions. They could not erase years of structural changes. But there was one thing they could try to change together: the price of the dollar itself. So in 1985, instead of letting the foreign exchange market slowly grind its way to a new balance, the world's major powers chose a shortcut. They decided to intervene directly, to coordinate, to manage. They chose the Plaza Hotel in New York as the stage. September 22nd, 1985, finance ministers and central bank governors from the United States, Japan, West Germany, France, and the United Kingdom gathered behind closed doors. Together, they represented the G5, the core of the advanced capitalist world. They did not invite voters, small business owners, or ordinary savers. They invited each other. What they discussed in that room was not a conspiracy in the shadows. It was something more brazen, an open agreement to push the dollar down. They emerged from that meeting with a short communiqué. Hidden in its polite language was a clear message. The dollar was too strong, economic imbalances were too large, and the major governments would cooperate closely to realign exchange rates. Those two words, cooperate closely, meant that central banks were about to enter the largest financial market on the planet and lean on it with their full weight. On paper, currencies float. Traders buy and sell based on interest rates, inflation, growth, and expectations. In reality, when multiple central banks decide to act together, they are not just another trader, they are the tide. After the Plaza Accord, the Federal Reserve, the Bank of Japan, the Bundesbank, and others began selling dollars and buying other currencies on a large scale. Whenever the dollar tried to strengthen, they pushed back. Whenever the yen or the mark tried to fall, they held them up. Day after day, in wave after wave, they signaled to markets, the old exchange rate is over. A new one is coming. Ride with it or be crushed by it. The effect was dramatic. The dollar slid. Against the Japanese yen, it eventually lost around half its value from its early 1985 peak over the next couple of years. Against the German mark, it fell heavily as well. What the market might have taken many years to do slowly, coordinated policy did much faster. For many American exporters, this felt like salvation. Their products became cheaper abroad. Some factories regained competitiveness. The political mood in Washington eased. Officials could point to the Plaza Accord as proof that cooperative management of the system worked. But exchange rates are not just lines on a chart. They are the backbone of trade, profit margins, and investment decisions. When you bend the backbone, other parts of the body twist in strange ways. Nowhere was that twist more dramatic than in Japan. Before the Plaza Accord, $1 bought roughly 240 yen. Within about 2 years, it bought close to 120. For a country whose economy depended heavily on exports priced in yen, that was an earthquake. Imagine half your foreign revenue evaporating in your domestic currency, not because customers disappeared, but because the unit of measurement changed. The Japanese government, understandably, did not want its export machine to seize up. The Bank of Japan responded by cutting interest rates to soften the blow. Cheap money flooded the system. Banks were eager to lend. Corporations and investors were eager to borrow and speculate. That wave of cheap credit looked for somewhere to go. It found land. It found stocks. It inflated real estate and equity prices into the stratosphere. By the late 1980s, some estimates claimed that the land under the Imperial Palace in Tokyo was worth more than all the real estate in California. Whether or not the comparison was precise didn't matter. The point was clear. Prices had detached from reality. This was not just a Japanese story. It was a ripple of Plaza. A decision taken in New York to ease America. A strong dollar pain helped inflate an asset bubble in Japan so large that when it burst in 1990, it would trap the country in stagnation and deflation for decades. The dollar bent. The shockwave traveled. And millions of Japanese savers, homeowners, and workers paid a silent price. In West Germany, the stronger mark put pressure on exporters but reinforced the country's reputation for monetary strength and discipline. The mark's role as an anchor within Europe became even more central. As currencies across the continent adjusted, European leaders were reminded just how disruptive large swings in exchange rates could be. The experience of the 1980s nudged them further down the path toward deeper monetary cooperation, and eventually toward something that would replace national currencies entirely, the euro. So from a few pages signed in a New York hotel, you can trace a chain of consequences, relief for U.S. exporters, a massive bubble and lost decades in Japan, and one more push toward monetary union in Europe. None of these outcomes were printed on the Plaza communique, but they were written into the system that followed. By 1987, the dollar had fallen enough that the United States and its partners started to worry about overshooting. A currency that is too strong can hurt exporters. A currency that falls too far can scare investors and ignite inflation. And once again, the same players gathered, this time in Paris at the Louvre, and agreed that the dollar had weakened enough and should now be stabilized. One accord to push the dollar down, another accord to stop it from falling further. Together, they reveal a reality that most people prefer not to think about. The value of money is not a natural law, it is a managed outcome. When people talk about free markets, they often imagine a neutral arena where millions of buyers and sellers interact and prices emerge from their collective judgment. But at the top of the monetary system, the rules are not written by the crowd. They are written by governments and central banks. Those institutions decide when a currency is too strong, too weak, misaligned, or in need of adjustment. They decide when to sit back and when to intervene. They do not ask small savers for permission. They do not poll households on whether the dollar should be worth 240 yen or 120. They act first. They explain later. That is not a conspiracy. It is a policy. It is how the modern system is built. The Plaza Accord is simply a rare moment when that power was exercised openly and visibly. Most of the time it happens more quietly through interest rate decisions, forward guidance, bond purchases, and diplomatic pressure. But the underlying message is the same. Your currency is not just a mirror of economic reality. It is a tool of strategy. So why does this matter now? Because the same forces are still at work, only with new names and new instruments. When you hear phrases like currency wars, competitive devaluation, or unconventional monetary policy, you are hearing updated versions of the old debate. Who should bear the pain of adjustment, and how much should currencies be allowed to move before officials step in? When central banks cut interest rates to zero and then below, when they buy government bonds in massive quantities through quantitative easing, when they openly say that a weaker currency would support exports, or that a stronger one reflects confidence, they are doing what the Plaza ministers did, just in a different style. They are moving the reference point of value. And every time they do it, someone benefits and someone pays. Exporters might cheer a weaker currency that makes their goods cheaper abroad. Importers might suffer. Asset prices might rise as money seeks returns, while savers watching their deposits earn almost nothing quietly lose purchasing power. Investors in other countries holding that currency see the value of their holdings change, even if the underlying assets don't move at all. For most people, these shifts appear as background noise. A slightly higher price here, a slightly lower return there, a vague sense that everything is more expensive than it used to be. The architecture behind it remains invisible. That is why the Plaza Accord matters as more than a historical footnote. It strips away the illusion that the value of money is something fixed, objective, and beyond human manipulation. It shows in a single dramatic episode that the strongest currency in the world can be bent by agreement, by design, and by policy. And once you see that, it raises uncomfortable questions. How much of your financial security depends on things staying exactly as they are? How much of your wealth rests on the assumption that your national currency is fairly valued, neutrally managed, and immune from sudden adjustments? How many long-term promises, pensions, savings plans, insurance contracts are quietly built on the belief that the unit they denominated in will stay roughly stable over the decades? History suggests that belief is fragile. In 1985, the dollar bent because a small group of people in a hotel decided it should bend. They framed it in the language of cooperation, stability, and rebalancing. They argued that the status quo was unsustainable, that the changes were necessary, that everyone would benefit in the long run. The language was soft. The consequences were not. Every time you hear leaders talk about orderly adjustments, market confidence, or enhancing competitiveness, remember that behind those words sits the power to change the value of your money in ways you did not vote for and may not notice until much later. Remember that what looks like a small technical shift in an exchange rate can ripple outward into factory closures, asset bubbles, lost decades, and entire regions reshaped. The day the dollar bent was not an accident. It was a decision. And it is a reminder that in a world where money itself can be redesigned by meeting and communique, the only real protection is understanding. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.